खबर है, and for that, Sumit is ready.
Well, if you see, Aarti Industries share prices were up around 6% yesterday on the back of strong volumes. And what we are understanding from our dealer check is that a large order is expected to be announced. And this order win for Aarti Industries will be from the Middle East. And this order will also include a tie-up for raw material. So the sourcing of raw material won't be an issue for Aarti Industries going forward. Now, if you see what dealers are expecting from this order is that earlier the company had downgraded their FY25 guidance, so this would provide this would mean some limited downside going forward. It will also give a strong revenue visibility, and what dealers are also expecting is that the demand is there might be some demand improvement for the company in the second half of financial FY24, and they're also expecting that inventory issues would normalize from FY25. Now, what management had indicated to us earlier or on the conference call was that competitive intensity is also going down. They're also expecting the competitive intensity to go down going forward. So all in all, a positive announcement is expected in Aarti Industries, and a slew of other key positive announcements like demand improvement, inventory normalization, and reduced competitive intensity is what the dealers are indicating, and this could lead to some price movement going forward for Aarti Industries. So keep an eye out for Aarti Industries in trade.
Coming in on Aarti Industries, that's a stock which is going to be buzzing today. In fact, let's check in on some of these buzzing names from yesterday. Let's see what Nykaa, or for that matter, Metro Brands is up to. Remember, they've announced a tie-up with Foot Locker. And that, of course, is a sneaker retail chain for those who are not in the know. Metro Brands holding up a good 5% as we speak right now. Nykaa as well will just come up for you on your screens next. We did play that interaction or exclusive interaction with Nissan Joseph as well, and he's pretty enthused about how Nykaa and Metro Brands are going to collaborate on Foot Locker's presence into the country. There's PCBL that continues to be in focus. They've signed a JV agreement with an Australian company as well for a $44 million infusion. So look out for that stock as well. And then see what Mahindra is up to. Quite a few marquee names which have come out after that fundraising activity. Mahindra, we haven't got the first rates there. Also want to check in on what the likes of an Axis Bank, M&M, Tata Motors. Remember, these were the ones which are charging up ahead yesterday and led us all the way to that 20k plus level. Tata Motors still holding up 0.5% as we speak right now. Axis Bank, M&M though has taken a bit of a pause. Axis HDFC Bank will just come off you on your screens next. Seems like a mild bit of green is what you can expect. But LIC, that's going to be one stock which is going to be in focus. Why is that? Let's listen in.
LIC is one of those stocks where right now the appetite by institutional investors is very low and limited. It was a value stock when it got listed, and it's been a value stock. Markets typically are not really very happy with the rate of the change what's happening in LIC. So I think LIC is going through its own testing and trying times in terms of regaining the attention of the market. Insurance as a category, while the growth is there, the market share dynamics are extremely different than what they were. The entire tax implications and the policy implications, tax benefits which the sector was enjoying over the years, that also has faded away. LIC has not done anything special in terms of gaining significant market share or going up in terms of regaining anything substantial. So could this product be a differentiating product for LIC going forward? Well, the brokerages feel that it is pretty much old wine in the same bottle, and other insurance companies have a better proposition. So let's see what the acceptability of the product here is. Sometimes it's not only about like-to-like comparison. Sometimes it's also about the ability to scale up a product. For example, HDFC Bank does not give you the best CASA, but it still gets about 20% of the fixed deposits. The smaller banks, they give you a higher rate of return. Corporate banks, they give you, mercantile banks, they give you a higher rate of return, but they don't that kind of an CASA because of size, reach, and branch. So I will not just shrug off this new product from LIC because HDFC Life product and other products are better. I think for LIC, the reach advantage would be there, but if they're able to scale it up, I guess the benefit of that really would be visible going forward.
Okay, let's tell you what the index strategies are this morning, and it seems like pretty much a consensus there. Both Kunal as well as Nuresh are recommending a hold for the Nifty for the Nifty, and I don't think it's going to be any different for the Nifty Bank as well. The Moodometer, of course, is a consensus there. Predictably so for the Nifty Bank too. It's a buy from Kunal and a hold from Naresh.
All right, those are some of the ideas. 9, 12. Naresh, let's look at two scenarios. One, today is FNO expiry. Tomorrow we start a new series and markets will be reacting to the outcome of exit polls. What kind of market setup are we in?
So the market setup is clearly bullish. And what we see is today we'll see a lot of volumes in the last 30 minutes due to the last day of the month, as well as a huge MSCI rejig happening, a lot of adjustments. But overall, from tomorrow, it should be much more clearer. But the fact remains, the bias is positive. We are seeing the heavyweights do well. So a test of new highs is what I would expect, say tomorrow or by next week.
Kunal, tomorrow, if let's say markets don't like the exit poll outcomes and it's a pushback by 200-300 points, then does that mean that we are done for the year?
No, I think that will be a good opportunity to go long yet again for an index trader in case for someone who's missed out into this 1,000-1,200 point rally for the index. I think we are at a point, Nikunj, where we'll have to look at the markets in isolation for the event, but not in isolation with respect to what's happening across the globe. There are so many emerging markets, global indices which are hitting new highs or coming back to the 52-week highs for themselves. Nikkei, I think, is very close to breaking that, and many of the other European indices are also coming close towards a strong breakout for themselves. So I think it could just be a matter where the event may be building up in terms of our market scenario. But I think post that, even if you have a 200-300 point dip, assumingly post the event, I would probably believe that that's a good sign to enter into the markets.
Okay, that's the take coming in the markets. Just taking a look at Axis, M&M, Hero MotoCorp, Tata Motors, or for that matter, HDFC Bank along with ICICI Bank. They were the movers in trade yesterday. Took a bit of a pause for the Adani group of names, which day before, of course, were powering ahead. And you saw most of them clock in double-digit gains. Yesterday was a bit of a pause day, as was the case for ONGC as well. Today, of course, is going to be a lot about those mid-cap newsmakers as well. What with the news flow on Aman Infra, you'll have Zomato as well that we're going to be keeping a close eye on. And of course, how soon do we inch closer to that 21K mark? Considering there are a lot of monitorables, expiry, you've got the state election outcome, you got to keep a close eye on way the dollar yield as well has been shaping up. So all that is going to be, of course, something that we're going to be looking out for. This Praj as well, which is going to be in focus today, they're targeting a 3x revenue by 2030. IHCL, wherein the management as well has indicated a higher revenue.
Good start. When I say good start, the breadth, again, phenomenal. 1:5, 1:4. These are the kind of numbers which just make everybody very excited about the market breadth. The small cap index is obviously where all the excitement is. So it's a flat start in absolute terms, but directionally I think it's a good start. We are building on the gains gradually. There is a FNO expiry and markets tomorrow will be reacting to the outcome of the state election. So bear in mind there are two, one technical factor and second a news factor which is important, but markets are digesting that. Zomato moving towards 120. Ashok Leyland post upgrades I think is looking rather decent. And Thomas Cook, well, that news about OFS, that is something which is having impact on the stock post. Indian hotels, they've increased their outlook in terms of how much money they will be getting by managing hotels. Now that's straight bottom line addition into their profitability of 200 crores more. That's like a huge number which they are now talking about. But the real star, hello sir, is IRDA. It was 50%, 87% yesterday, and today also it's just a phenomenal start for that one. So that's like, Aisha, real exciting factor in the market right now.
Yeah, and it doesn't seem like that fizz on the stock is quite done. After an 87% move yesterday, today as well, it gaps up by about 13%. Of course, today you'll have another one hopefully join the bandwagon, and that's going to be Tata Technologies as well. But that in just a bit. PCBL, that continues to be in focus. The silicon, they've taken up a silicon tech tie-up with an Australian partner. There's Zomato, Man Infra, where marquee investors have checked in the block deal yesterday on Zomato, and Mahindra, the fundraise as well, 0.5% higher for both those stocks. Praj Industries, wherein they're targeting a 3x revenue by 2030. There's IHCL, wherein they've talked about a fee potential of 600 plus crore rupees versus 400 crore rupees that they'd earlier indicated by 2025. ICICI Securities, they've got the approval for delisting from both the exchanges, BSE and NSE. I want to see what Metro and Nykaa are as well up to after that tie-up with Foot Locker. Those stocks were looking mighty excited in the pre-open rates itself. Metro, of course, seeing a bigger pop there, 5.5% higher for Metro Brands, and Nykaa as well gaps up by about almost 2%. Not much in terms of negative news flow, but yeah, I mean Tata Chemicals, GHCL. Remember, they've cut the prices of domestic soda ash for all grades, so maybe that's going to be one stock in focus. And RR Cable, wherein the income tax department is conducting search operations at some of the offices of the company. Those are a couple of names which are in focus right now. Also, Thomas Cook, the promoter, is looking to sell up to 8.5% stake via an offer for sale, and the floor price has been set at 125 rupees per share. And I think that block has happened, 5% lower for Thomas Cook India as we speak right now. Kunal, the first trades that you're looking to execute.
Well, in fact, at current levels, I think Hero MotoCorp is something which I would believe that would start to look to book profits over here. The stock has run up some 600 points in the last 1 to 2 weeks. So from the 3,350 mark where we initiated to buy at current levels of 3850, 3900 mark, good time to book out profits.
All right, Naresh, let's get in your take on the markets. Given the current levels that we're perched at, what do you make of the trade setup? And take us through your first trade.
So the trade setup is still bullish. Looking at LIC Housing and the whole housing finance companies for a broad move. So LIC Housing at current levels as well as Canfin going forward.
Well, Ashwini Agarwal joins us now. Let's take our conversation forward and let's understand that what his opinion of the market is. So Ashwini, so far so good. A party which started just before Diwali looks like has got some more legs left.
Yes. Hi, Nikunj. Thank you for having me on your channel. I agree with you. I think the party looks to continue for the simple reason that, market's been climbing a wall of worry. And if we turn the clock back a couple of months, the worry was on the interest rate environment, on inflation and slower growth. And suddenly the narrative seems to have changed that inflation is moderating. Interest rates have come off in the US if 10-year government bond yields are to be observed. And now there's a narrative building up that US might actually be heading for a soft landing, which was seen as a very difficult outcome. So a lot of money that was kind of waiting for a correction is now being forced back in. That's how I see it. Earnings season has been reasonably good. So, those are the drivers for the market. So that's what's driving things right now. Having said this, one also has to be cognizant that there are accidents possible given the rate increase that we've seen in the US over the last 2 years and the massive shift in interest rates environment compared to almost 20 or 30 years of very low interest rates and 0 to negative real interest rates. So now you have real interest rates in the positive territory. So, does any accident come out of that, event come out of that? We don't know. And then you have the elections results next week, which or later this week on Sunday, which will again probably shape, some of the sentiment in the short run.
Yeah, but you think it could lead to a big shake-off, Ashwini? The exit polls are today, and of course you'll have the results come in on Sunday for the state elections. Is the market already not penciling in a complete majority by the current ruling party?
So I see you're right. To some degree, the market is kind of ignoring the elections, which is always a very dangerous thing to do. And you may be right that the market is, kind of discounting a good outcome for the BJP, and that may or may not happen. So yes, that's an issue. But, having said that, even if there is a little bit of a shake-up, I think the history tells us that state elections and central elections are very different things. So to extrapolate what happens at the state level as an outcome for the general elections middle of next year might be a mistake. So I think, even if there is a little bit of a sentiment hit, market will want to move on. Unless there are read-throughs which suggest that this is not just the states, but it has something to do with the center as well. So we'll see how that narrative shapes up. But state elections and central elections are different. That's what voters have told us over the last 15 years or so. So that narrative might continue to stay.
Ashwini, I was looking at data in the morning that the market cap to GDP of India is at par with each other. And every time it has crossed 1 or 1.1, it has always led to selling or unwinding. This is a Buffett indicator I'm talking about, very old school. And in this right now, large cap stocks have not rallied. Everyone is saying large cap stocks will rally further. So I'm just confused. I mean, if the market cap to GDP is already higher and large cap stocks have not rallied, then what happens?
So great question, Nikunj. I was also debating about this, and then I went back and looked at the long-term Nifty PE multiple, and where does the +1 standard deviation, -1 standard deviation number stay? I was looking at a Motilal Oswal research report, which pegged, if I remember right, the EPS for Nifty for March 25 at 1140 or something like that. And if you multiply that by 19 times, which is the +1 standard deviation number, which Nifty has often done in the past, then 1 year from now, the Nifty should be at something like 22,000 levels. So, give or take 8-9% upside from here. So you're right, even on earnings basis, the upside is not significant from here. And on that Buffett indicator of market cap to GDP, you're again, at pretty much a peak. But this market cap to GDP is also a misnomer in my view, because large parts of the GDP are not listed. So how do you correlate market cap to GDP? I mean, what sense does that make? I mean, our agriculture doesn't trade, which is a large part of the GDP. A large part of the SME sector doesn't trade. A large part of government services, which make up the GDP, don't trade. So I don't know, whether market cap to GDP is a good indicator anyway.
Ashwini, hi. Wanted to also get in your take as to what the outlook is when it comes to the overall earnings growth. Where is it that you believe that within individual sectors in India, there's strong scope of earnings growth?
I think, if you drill down on the sector side, first of all, let me take a step back. I think one point I'd like to make is that the world at large will grow slower going ahead than it has done over the last 12 to 18 months. That's my base case. I could be wrong, but that's my base case. And following with that base case, my sense is that the Indian real GDP growth will be in the vicinity of about 6%, give or take. You add inflation to that, 11%, and you add another 1 or 2 percentage points to that, you can expect broad market earnings growth to be in the region of 12 to 13%, maybe 14%. Now, within that, obviously, there'll be leaders and laggards, right? And the question you're asking me is, who are the leaders? My sense is that everybody that had a headwind over the last 3 or 4 years will probably do better in the next 2 to 3 years. So, pharmaceuticals, we are already seeing an earnings turnaround there. Automobile stocks, for 4 years, automobile sales have barely grown. We are seeing very strong demand for cars, a revival in demand for two-wheelers is visible in the holiday season sales, Diwali season sales. So maybe that's an area where we can look for some rebound in earnings. Downstream chemicals, people who were hit by high input costs and by high transportation costs is another area where I'm looking at earnings normalization. And so those are 3 areas that I can think of at the top of my head. IT, I've been looking for a turnaround there in earnings, but I haven't found any data points on which I can hang that thesis more firmly. So I'll stay away from recommending that as a candidate for earnings turnaround or leading in earnings recovery.
Ashwini, while that is an earnings-led view, where is it that you see pockets of exuberance in the markets, if any?
Oh, well, that's a good one. There are lots of pockets. I mean, a whole bunch of defense-related stocks, railway-related stocks. Some of the consumer names continue to be reasonably expensive. A lot of the small caps are now getting into very expensive territory. So there are a lot of pockets of exuberance. I mean, my simple philosophy over the last 30 years of investing and having made my share of mistakes is that you have to look at trailing earnings and PE multiples. I mean, everything is a cycle most of the time. For 80-90% of the stock, the cycle applies. And if there are stocks that are trading well above their +1 standard deviation on a PE basis, EV to EBITDA, price to book, price to sales, whatever number, that appeals to you basis that business. If they're trading at +1 standard deviation or higher, on the historical basis, not forecast, mind you, then you have to be very careful and you have to make a base assumption that this is a bubble. And then, look for reasons why you still don't want to accept that as a bubble. So, if you look at stocks with that lens, there are a lot of pockets of exuberance, honestly.
Example, I mean, when you say exuberance, will consumer staples qualify the cut? They may be expensive, but they are great companies.
They are great companies, but Nikunj, you've been around, I've been around, right? Let's go back. In 2000, I still remember levers was trading at whatever, 45 or 50 times. It made you no money till 2008, okay? Between 2011 and 2021 or so, it beat the market by a very, very wide margin. And while the earnings growth was more or less similar as the previous decade, the valuation multiples went through the roof. So I think, stock price performance is a function of not just earnings growth, but what valuations you're paying upfront. So a lot of the consumer names have entered the current cycle at a very high valuation multiple. And that valuation multiple may take some time to correct. Now, when does that correction get over? I can't say. Typically, you have excesses at both ends. When the valuations getting built up, you end up with an excess. And when valuations are getting derated, you get an excess. So is that excess already done? I don't think so, but that's my view. So I don't think the earnings of levers or the quality of consumer companies is poor or the business environment is poor. No, not at all. They will continue to grow very well. But I think the valuations that you're paying for them might still be a little punchy.
Are you fully invested, Ashwini, in this market in the family office money which you manage?
I mean, I'm always around 80 to 90% invested. Very rarely do I go below that. And I'm talking about my equity allocation. So there's a fixed income component. So I'm very disciplined about asset allocation. And I think that, most of your viewers should look at their asset allocation very well and very closely. So there's a fixed income component and there's an equity component. In the equity component, I'm usually 80 to 90% invested, which is where I am right now. I mean, there are very few times I have gone well below this number or much higher than this number. So I'm pretty much, where I normally am.
Fixed income.
Hello?
No, what are you buying in fixed income? Are you looking at buying REITs? Are you looking at buying corporate debt? How are you investing there?
Sorry, I didn't hear that question. So in fixed income, there is a combination. So there are government bond funds at the longer end because I think that over the next 2 to 3 years, yields might correct a little bit. So you'll pick up not just the yield, but you'll pick up some capital gains. There is a section which is in REITs, which have got very badly derated over the last 2 years or so. And I think the current yield on a post-tax basis is very interesting. And they're all trading at discounts to their NAV, at least the real estate ones. And there, one can expect some appreciation. Due disclosure, I own the REITs. So if I'm recommending them, investors should take note that I have a vested interest in saying so. And then there is, another portion of the fixed income portfolio relates to NCDs, some structured products, etc., etc. So overall, trying to make sure that I get a reasonable yield on my fixed income portfolio.
Ashwini, thank you for joining in and sharing with us your outlook on the markets. Good to have you on
You're
board.
welcome.
So yes, be cognizant of potential accidents in the markets, but as of now, the outlook is that they are climbing the wall of worry. Perched at 20,116, that's where the market is currently at, 31 points higher for the Sensex. The broader markets holding out. In fact, the small cap index up by about 0.5% or so. But lots more to talk about. And as we delve deep into the cement sector, understand a little bit more about what the entry of larger players means when it comes to market share, where raw material prices are headed, and what the growth path ahead looks like. Joining in on this discussion is Sandeep Ghosh, Managing Director and Chief Executive Officer at Birla Corporation. We also have with us Rakesh Arora, founder in Go India Stocks, who tracks the sector, of course, very closely. Good to have you both on board. Thank you so much for taking time out. Mr. Ghosh, I'd like to begin with you. Given that we have just recently seen UltraTech Cement announcing that acquisition of Burnpur Cement's grinding assets, I just want to understand what the outlook is on the sector as a whole. Do you think that the consolidation within the space is only going to continue?
First of all, Apeksha, thank you very much for calling me in for the show. And I'd like to begin with a health warning, statutory warning. I'm speaking in my personal capacity as an observer of the cement industry for a long time. And if I may say, as somebody who is coming from outside space, so I see it more, slightly on an independent footing than cement insiders. And whatever I say does not represent the views of my company or the group I work for. Having said that, I think this hype about consolidation, which has been going on for a long time, is highly exaggerated. And I'll come back to tell you why. But before that, I would say my view is the way the cement sector is behaving just now is behaving very sensibly. While one could always expect more, people could expect, a bull run or, prices going much higher. But I think if you see overall, the moderation of what has been happening in the market is very much, I would say, within the sensible band. And that is something which one needs to take note of. And there has been right from the beginning of the year, if you see what was predicted in terms of volume growth, and in the price scenario, it has largely lived up to that. Nobody was expecting a huge price shoot up during the year. People had all projected, all analysts, all firms, they had projected that price will remain more or less stable. And that's exactly what has happened. Even during the festival season of last month, that's November, you see the prices have been largely resilient. So I wouldn't attach too much importance just now to all this talk about consolidation. I'll answer this Burnpur cement thing, and then we can come back to this topic later after we've heard others. Burnpur cement, I think, is a very small readjustment of capacity. It's not a big capacity. UltraTech has been in talk with them for a long time, and it's just kind of a local readjustment. It's not a major development, and it does not indicate a larger trend. Sorry.
Right. Let me also encourage your Rakesh Arora to join in here. Rakesh, a company would always say we have a 5-year view and we take a 10-year view. But markets would say we have a QSQT view, which is quarter se quarter tak. In that, the problem is that coke prices have gone haywire. In that, the problem is that raw material prices have shot up disproportionately higher, and cement companies really have not kept up with what the impact has been. So while the big picture is great, we all love India, cement will grow if India grows. But in the QSQT outlook, there is a bit of a challenge. Rakesh Arora.
See, I think there's an improvement QOQ both on realization and costs have kind of stabilized QOQ. So I don't really see too much of, margin pressure. Actually, margin should expand in Q3 as compared to Q2. Demand obviously has taken a knock in November because of festive season, and also North India normally, during winter, sees some curves on, agglomerate mining, etc. So, and even construction activity takes a little bit of backseat. So demand is slightly weak, but it is better QOQ. And Q4, I think, would be the best of the last few quarters that we have seen. So near term is looking decent. It's not really as bullish as one would have liked it to be, but there's more competition intensity that we are seeing, and but things are on an improvement trend.
Rakesh, cement is one commodity which cannot be imported. Cement is one commodity which, in a sense, enjoys a complete multiplier impact when it comes to the GDP growth. It's a play on real estate and it's a play on capex. The sector is doing. So if I look at the demand drivers, the demand vectors for cement, I think last 24 months it's been strong. Real estate is growing, roads are getting constructed, buildings are getting constructed. But yet some would argue and say that it's been a okay setup for cement companies in terms of the numbers what they've reported.
So I think the spoil sport was actually, the industry major who has been pushing aggressively to gain market share. And this has happened in light of acquisition of wholesale companies by Adani. So there's a little bit of tussle going on at the top. And that has meant that, EBITDA margins, which could have expanded to around, say, 1,200 to 1,500 rupees per ton, given the demand scenario and the capacity utilization. But little bit of aggressive posturing by the top player has meant that, margins are reasonable. They're not weak, but they are reasonable. At the same time, this also means that there's a lot of consolidation opportunity coming up because margins are not that great. Smaller companies are folding up. Either they have to expand or they have to sell out. And the second scenario is currently playing it out.
All right. I wanted to understand from you as well then, Mr. Ghosh, as to what the outlook is in terms of the general elections and how you expect the overall demand to pan out for the cement space at the time.
Before I go, I'll just make a comment about the demand, which Rakesh mentioned. And, if you see the demand pattern in the last few months, it has been evening out. October was a very good month. November was subdued because of the whole series of festivals and various other factors like harvesting. So you had Chhat, you had Diwali, and the rest of it, which kind of subdued. Similarly, we have seen in August and September. So overall, as Rakesh is saying that, the demand has been steady, and we'll of course expect to see how things go in the next quarter. Now, elections, if you ask me first, I thought is the key point is to see the results, which will be out tomorrow. Or tomorrow, in the sense, tonight we have the exit polls. You'll have Sunday the results. So that could have one should see an impact in terms of sentiment for the general elections. But by and large, I don't see again too much of a turbulence or disturbance between now to the general elections, except for the fact that you will have the model code of conduct and everything setting in probably by February. So after that, especially the central government schemes and expenditure on those might slow down. But till then, I think you should see a fairly steady demand. If there are changes of government in some of the states, as some might anticipate, that could cause a little bit of dislocation in terms of the state spending. But if there are no changes in government, you will find the overall developmental and infrastructural expenditure and expenditure in welfare schemes such as PMAY will remain on top gear between now to the elections.
What is the outlook then, Rakesh, from you when it comes to the overall valuations within the entire cement space? Do you believe that, some of these stocks are trading at expensive valuations? Is there any scope for derating according to you?
Unlikely these stocks will get derated. Meaning they are expensive valuation, but they have been trading at these levels for a pretty long time. So this has kind of become the norm. The driver is obviously going to be improvement in earnings, and as I said, Q4 looks pretty decent to me, and maybe even Q1 of next year should be okay before the post-election slowdown actually hits the industry. So next 6 or 8 months are looking decent to me, and I think the stocks are going to be well supported.
Okay, fair enough. And wanted to understand from you then, Mr. Ghosh, as to what the outlook is when it comes to the company in specific. Are you on track to achieve that 15% volume growth?
As I mentioned, Apeksha, at the beginning, I would not like to comment on the company, but to answer your question, we are not changing any of our projections, which we have only recently shared both in our results release as well as our subsequent conversations with investors on telecalls.
Try my luck. It's Avan this side, by the way. But thank you so much nonetheless for taking time out and joining in, Mr. Ghosh, as well as Rakesh. Good to have you both on board to understand better the dynamics of the cement space. All right, let's move right to it then. And the talking point of the day, Tata Tech, will be in the spotlight as expectations are that we could see a pretty bumper listing. And let's revisit the editor's take on Tata Tech IPO.
Okay, Tata Tech. Now, look at the grey market premium. So, what the offer price was, that really becomes irrelevant. Now, let's look at two scenarios. If you look at the grey market premium, we are looking at a listing anywhere between, well, closer to about 900 rupees. At 950 rupees, it will be trading at a P multiple of 53 times. If it's a 100% listing, considering that there is an underlying, vibe and a strong current, and being a Tata Group company, and after yesterday's Zirda experience, everybody would like to, rush for it. So let's say it makes a debut at 100% premium. It makes a premium at debut at 100% premium. The market cap would be 40,000 crore, and the P multiple would be about 55 times. At 55 times, what are the comparables? Well, at 55 times, you compare IRDA with other tech companies, and you would say that it's reasonably priced. So at Tata Tech, after 100% premium, you compare that with KPIT and other peers, not too many peers are there, but you would say that Tata Tech actually would be fairly priced. So rather than chasing the stock on the listing, and if the listing is more than 100% premium, it may not be a great idea. If you own the stock, you got lucky in the allocation, please don't sell. But the margin of safety in the near term, if you're buying a stock, an IT company, even though it's a Tata company, after 100% pop-up may not be the best of the idea. You want to be a buyer in Tata Tech, but when there is a decline or when there is a profit booking in the market, the stock will occupy all the limelight. It will be like the talk of the town. Everybody is excited. Everybody wants to know more. There is this, fly in the ointment, so to speak, about them running into some rough weather with a client. That may just take the niche away. But my limited point is, you have to be very clear in what you're chasing. To chase momentum in Tata Tech after 100% listing, after 100% gain, may not be a great idea. To sell the stock even after 100% listing is also not a good idea. So then what do? Just wait if you don't have the share.
Okay, on that note, we're going to take a very quick break, but don't go anywhere. We've got Tata Technologies, the mega IPO from the Tata stable. We'll go full tilt on the coverage in just a short while from now.
Island kitchen.
लॉक करें?
और जब ये नया फ्लाईओवर बन जाएगा ना, मॉम एंड डैड विल बी जस्ट 20 minutes away.
तो परफेक्ट नहीं है घर. इसीलिए housing.com with maximum properties. housing.com पर से perfect.
Back with first trades, and keep an eye out on the new listing of the day, the pre-open indicative price. And wow, that really is telling of the kind of listing, bumper listing, Nikunj, that we could see later today. And the D Street debut is going to be nothing short of spectacular, I guess.
140% is something which You sometimes get speechless when you see something like this. My only worry is that when you see, let's say, Tata listing, Tata Tech listing, and when they make debuts which are 100% higher, 150% higher, and in today's market, not that merchant bankers are leaving a lot of value on the table, but when these stocks they go that much higher, that just tells you that is this euphoria, or what's going on? Typically, these are telltale signs that there is just too much of action and perhaps euphoria or perhaps excitement in this entire IPO market. While it's a Tata Tech company backed by the Tatas, but ultimately what markets search for is valuations. Now let's look at it. We'll put a table out, and we've not, our assumption was that it will be 100% listing. Maximum pop-up 100%, but this is 140%, and post-listing it could rise more. See, my view has been that if you're in for a long haul, don't sell the stock. It will be a stellar listing, and after that stellar listing, it will continue to outperform. But this is where it stands now. So that 70%, 80% does not matter. Let's look at 90% and let's look at 100%. And I think we'll have to update our graphics also now, because we only calculated it 110%. But at 100% premium, it will be trading at 55 times on a trailing basis. Let me write it down. I do a maths up and I say, okay, list that's about 150. So 55, just bear with me, simple maths. That makes it about 70 plus. Now at 70 plus, an IT company, when the peer set average with companies which have years and years of track record, and markets like their numbers, market understand their numbers, market understand their pattern, you could ask yourself that whether it's a Tata Group company or whether it is from any other corporate house, you are actually buying something at 75, 80 times on a trailing basis. And that may not really be the best idea to invest in any stock. Best of the stocks, if you bought them at the wrong price, they've not made money. So here's what I think one should do. If you have got lucky in terms of allocation, just don't sell. Don't sell. If you're planning to buy it now after a 150, 160% pop-up, please don't buy it now. But you definitely want to buy when there is a bad patch in the market. So don't chase the stock. Wait for the decline. Let the stock come to your comfort price rather than you getting discomfortable at buying at a price where the future gains are not going to be there. You don't make money when you buy stocks at 70, 80p multiples on a trailing basis. That's what history is. And best of the companies, Nestle, Lever, Tata Consumer, best of the best companies get into time-wise correction. We've seen that graph, right? HDFC Bank, the darling. From 3 years, it has not made money. Kotak Mahindra Bank went to price to book of 6 times. The Kotak Mahindra Bank, 3 years, it's not made money. HUL, 4 years, it's not made money because valuations were expensive. I think after 100% listing, 150% listing, that may be the story for Tata Tech.
And mind you, this after all that speculation around the second largest client, VinFast getting into the trouble, its stock eroding about almost 90% of its value. Irrespective of that, this is what you're having only on the indicative price, and I'm sure that the listing will be much higher than this.
Yeah, so the indicative price for IDA yesterday was 50%.
Yeah.
And it then
closed with 87%.
Yeah,
gains.
so it may actually well be the case. But what I'm amazed is that the action and the excitement which is suddenly happening in the IPO market. 3 listings today, while Tata Tech will occupy all the lion's share of mind space.
Gandhar Oil is there.
Gandhar Oil is also there. So, it's all happening in the IPO market. That's my only worry right now, if you ask me, that too much of excitement in the IPO market. IPO market is often considered to be your gateway to make easy money. You get lucky, you sell, you go at the finance route. If you get a lottery, you will be able to get in greater exit price. So it's like a toss of coin. It is chance, not skill. And when you start betting on chance, not skill in the stock market, it's always very dangerous. Stock market is skill, it is not chance. So that's what I always say.
Yeah, that's Tata Technologies, not obviously such stupendous gains for a Gandhar, though it is indicative of a premium to its issue price. We will track those new listings in just a bit. But let's also welcome on board Viren Prasad Shetty, Executive VC at Narayana Healthcare, joining in the show right now. Viren, apologies to keep you waiting. We were just marking Tata Technologies and the IPO from the Tata stable after almost 2 decades. But let's talk about your business. And, the street seems quite happy with your Cayman performance, because after 4 to 5 years of initial habitual underperformance, this business not only witnessed a turnaround, but now I believe contributes 40% to your EBITDA. How do you see the growth rate sustaining in terms of realizations per patient, etc.?
Well, you just also have to remember that Cayman Islands for us is a very, very small market. I visited a tech park yesterday, and the entire number of people working in that tech park is greater than the population of the whole country. So this is a temporary thing. There's a lot of latent demand for healthcare in the Cayman, but being a small population, we cannot sustain these growth rates. Now we're adding and expanding the number of specialties that we are offering. We're offering oncology, daycare, pediatrics, NICU, orthopedics in a new facility that's a lot closer. So that obviously should bump it up a little bit. But with mature populations and stable countries, these things can't sustain the way it is in India.
Good morning, Nikunj also joining in. Now, your whole investment into Cayman Islands, some would say, was never to cater to the population of Cayman Island. It was always an arbitrage which in a sense gave to folks who wanted to come to Cayman Island looking for better surgery at an affordable cost. That I think is really the big thought when you invested in Cayman Island. Has that thought worked into reality for you? Is this model which is a scalable model and you could be scaling it up in some other geographies?
No, you're right. Our first thesis with setting up this hospital was to be a hub for medical tourism for North America. Our idea was to grow this into a 2,000-bed hospital that will treat thousands of patients coming from the US, Canada, Mexico, South America. It didn't work out. It didn't work out because we had no idea of the geopolitical realities at the time. What has worked for us is to run something that's smaller, a lot more efficient, just catering mostly to 80% local population and 20% to people from the neighboring Caribbean islands who don't have an option. So that's a little bit of pivot that we had made, and we're doing okay with that.
Would you be looking at perhaps exploring more geographies? Because, you know, this is more than a lab experiment, right? And somewhere you've invested and you're expanding. Are there any other pockets where you could be replicating the same kind of a model? It may not be for North America, it may be for Europe. It may not be for Europe and America, it may really be for some other geography.
Absolutely. See, the thing is, as an Indian company, we have built a set of capabilities. We run extremely efficient processes. We have very good technology for running our hospitals, and we have an excellent management team and excellent clinical talent. Now, if we're not able to leverage that into foreign markets, then we'll be stuck fighting in a very relatively small pond, even though it's one of the largest ponds in the world. So just like Cayman, there are other geographies where maybe not to the exact demographic and not to the exact margin structure, but there are places where we can leverage what we have and bring our advantages to running healthcare systems there, because providing healthcare is a globally understood problem at, they're not able to provide it at a very affordable price. Only an Indian operator can come in with that right mix of very high quality and low cost. So we are exploring that. But we also have to keep in mind that those opportunities are few and far between. If we can get it at the right price without having to spend too much money, we would explore that.
I can draw a parallel here. Just a coincidence, hospital and hospitality, right? The hospitality industry also seems to be following a model where they are making balance sheets asset light, and when they are using their expertise to perhaps get into more management contracts. You also have done that. Is that the way forward for you now, that what you've done in the past, keep your balance sheet light, look at more management contracts, and keep on extending your expertise going forward?
No, not really. We tried that. The thing is, it works until it doesn't. So the difference between when you take a building and you rent it out to a hotel, there's a lot of fungibility of the asset. And so what happens is, if one doesn't work out, you can always scale into another. But hospitals are always purpose built. So it's very hard to find someone who will take on the asset risk and build something completely designed for just one client and take all the chances that the client may walk away. So the rentals and the yield expectation from the asset owners becomes extremely high. The other problem is that hospitals need tremendous amounts of reinvestment, not just in the medical equipment, but also in the interiors, in a lot of structural changes, which asset owners are not always willing to do, or if they want to, again, will increase their yield expectations. So we've not found that to be sustainable for very large hospitals. Now, there are other hospital groups that are trying that, and they will have a lot more luck than we did. We haven't had good luck in that. The asset light expansion is a lot more relevant for us for smaller format clinics small daycare centers, diagnostic pharmacies. That's where it makes sense. For hospitals, we've just not had a good track record doing so.
So what is the outlook in terms of now the big triggers for the India business going forward?
There are a lot of things we're working on improving our throughput, on increasing the amount of digitization, on increasing the number of patients our hospitals are able to serve. We're in the middle of a 3-year roadmap for eliminating nearly every physical counter in our hospital. We don't want patients to have to wait, to have to walk around with files and paper, to have to sit and wait in queues to pick up anything. So we want all of this to be done either on their phone or to be done on WhatsApp or on the phone call. And this is something that will vastly streamline the experience of going to a hospital and allow us to see a lot more patients in a day.
Okay. Final question. I just wanted your thoughts on what's happening in the Indian healthcare sector. A lot of P investors have come in, and when we speak to the P folks, they are profit focused, they are maximizing and sweating the assets. And there's a difference in which how the Indian healthcare sector now seems to be approaching this entire healthcare versus cost management approach. Is there a tectonic shift in the healthcare sector, given that a lot of P investors have come in and they're very cost conscious and they're very profit conscious? Because healthcare ultimately it's always has to be profitable.
So it depends on what level of profit, right? You can either go for profit maximization or you can go for a sustainable level of margin. This is a business where we've always believed that there is a sustainable level of margin that is required for reinvestment, for upgrading the infrastructure, for providing this world-class experience to the patient. And I guess a lot of PE people are aligned around that. Now that there is interest in investment, is on net a good thing? Because this happens, more infrastructure gets created, more patients have options, and it's not that you are forced to go to these hospitals. If someone comes in and takes over a hospital and it's very expensive, you don't have to go there. There are much more affordable alternatives available, and that's a segment we are looking to play in. But it does, for temporarily cause a little dislocation of valuations, and for hospitals who are buyers, maybe the price is a little high. For hospitals who are sellers, good deal for them. But since we are neither, we're just building our own business and expanding our own capabilities. We can just sit on the sidelines and watch and be, slightly entertained by all of this.
All right, good to have you on board. Thank you so much for giving us more clarity on how business is shaping up. We'll take a very short break. Tata Tech IPO, the listing coming up.